Okay, good afternoon, everybody, and thank you for joining this InvestEngine webinar on investing your business's cash. My name's Andy Prosser. I'm the head of investments at InvestEngine, and today I'm joined by a panel of industry experts who are going to be offering their insights into all things business investing. So we're hoping to cover a broad range of topics today, everything from the tax implications of investing business cash to the types of funds businesses can invest in, to some more general advice from our panelists. Some of whom have been investing on behalf of their businesses for quite a few years. In terms of the webinar, it's going to be a bit of a Q&A. I've got some questions I'm going to be asking each of our experts, and then we'll be taking some questions from the audience as well. It's my job to keep everybody on time, so we'll probably spend about 35 minutes-ish on the questions I'll be asking, and then we'll leave about 10 minutes at the end for Q&A from the audience. So aiming to be wrapping up about 5:45. So if you're watching this and you do want to ask questions as we're going through the presentation and the Q&A, you should be able to click on the Q&A button in the bottom of the screen. The questions won't be broadcast to the whole webinar chat. They'll just come straight to us. So don't worry if you think you've got a stupid question, that's absolutely fine. Feel free to ask away, and then between us, we'll answer as many as we can at the end. Okay, before we get going, I'm just going to quickly ask our panelists to introduce themselves. And just to make things easy, let's follow the order that we've got on the slide there. So if we could start with you, please, Andrey.
Hi all, I'm Andrey. I'm the CEO and the co-founder here at InvestEngine. We launched business accounts 5 years ago, and we're here to help the UK SMEs.
And Ian?
Yeah, I'm from a company called Back Office Support Solutions. We trade as Ask the Boss. We're basically a full-service boutique accounting and finance partner to firms, individuals, basically growth firms and technology businesses. So we do all sorts of annual accounts, tax. And my role here is to look after all the compliance. So I'm not just looking after the investments of the business, but also to make sure that as a firm, we comply with all the rules around GDPR, data protection, anti-money laundering, and I also have responsibility for health and safety, HR, and legal.
That's a lot of stuff. Over to you, Ellis.
Good afternoon, good morning, whatever time it is you're listening to this webinar. My name's Ellis. I'm a chartered accountant and founder at EA Accountancy. Business is going 3 years now. We predominantly target startup businesses and SMEs in the UK, helping them from the startup phase to obviously scaling and growing their business to potentially exiting if that is of interest to them.
And last but not least, Jamie.
Last but not least, thank you. So I'm Jamie Fluck. I'm a chartered and certified financial planner. I run Lab Financial Planning, which is an independent financial planning company working specifically with business owners and busy professionals, typically helping business owners invest their business cash and also help them potentially plan for exit and their long-term planning and how their personal and business financial planning crosses over.
Good stuff. Yeah, thank you all for being here. Great to have you all here. Just one final point to mention before we get going. It's a bit of a boring one, but I do have to mention the usual disclaimer that your capital is at risk whenever you invest, that this webinar is for UK residents only, and that none of this is financial or tax advice. And with that, I'm going to stop sharing my screen and we can get stuck into some of the questions. There we go. Right, okay, so let's start off with the basics then to kick things off. I think the first question is, why should businesses look to invest their cash they're not using? What are the benefits? And I think Andrey and Jamie, you're probably both best placed to answer this one. So maybe let's start with you, Andrey, and then maybe Jamie, you can follow up.
Yeah, sure. So the short answer is to beat inflation and to make their idle cash work better. There are reports that there's around 150 billion pounds sitting in SME current accounts that pay no interest, and a further 125 billion that pay little interest, significantly lower than individual accounts pay. The UK SMEs, they lose around 9 billion annually in interest payments due to this. And if you don't want to be one of those companies, then you should consider investing. That's my take.
Yeah, I'd echo much of what you said there, Andrey. And the inflation, sometimes known as the silent killer, it's certainly in financial terms. So, put in some context on what you were just saying. I went back and looked at kind of what inflation has been over the last few years, particularly as we know it has been so high. It really surprised me, actually. I looked at using the Bank of England calculator. If you had £100 in 2019, that you would now need £125 to be able to buy what you could buy 5 years ago with £100. So, in essence, over that 5 years, inflation has risen 25%. So you'll know with your money that's sat in the bank, potentially, whether it's personal, whether it's business cash, that's not gone up by that much in that period of time. Essentially, you've lost money in real terms. So you can't do much about what's gone before, but you can certainly make sure that you're doing the right things now to make sure that your money's at least keeping pace with inflation going forward, so it doesn't lose its real value. And exactly the other point as well is about how much is tied up in these accounts. You know, you work hard in your business to grow the business, to make sure that it's revenue generating, profit earning. You don't then want the money to just sit in the bank doing nothing and again in real terms losing. So you want to essentially take back that control and make sure that it's working hard for you as you've worked hard to build it in the first place.
And those current account rates, especially for business accounts, are notoriously bad, right? I mean, I'm sure you'll know better than I will, Jamie. They don't quite match the rates that we tend to get for our personal accounts. I think the business accounts rates just tend to be lower for whatever reason.
Yeah, it's a real funny one. I tried to look into this as to why, and I can't come up with any better reason than just the fact because they can get away with it. They can.
Yeah.
Nobody's, or certainly until now, nobody's really challenged that status quo and said, we'll actually offer you a good rate of interest if you put the cash with us.
So that's kind of a good explanation for why businesses should be investing, right? Inflation is that silent killer. But which kind of pots of cash should businesses actually be setting aside for investing? Ellis, as the accountant in the room, and Ian, as someone who actually does this, you guys probably best placed to answer this one.
Yeah, I think I'll go first on this one. As the accountant, we're typically quite risk adverse, I'd say. My honest advice to a lot of my clients is, first of all, you want your money set aside for taxes. You then want money set aside for almost like a run rate. So say, for example, your business was closed down tomorrow. You want between 3 and 6 months worth of expenses set aside to almost give you that mental space, that headspace, if that was to happen, to actually grow the business and not have to worry about paying bills. Now, money in excess of that, if it's not being put to use, it's not being saved aside for, I don't know, investments into the company, such as equipment, et cetera, it is wasting away and it is decreasing in value. That's typically how we have the conversations with clients is, yes, have your money set aside for taxes. Maybe you want to consider a low risk fund for those taxes, so actually getting a bit of a return. Because as you guys quite rightly mentioned, bank interest in business accounts is virtually non-existent. But that's the advice I would typically give as an accountant to clients.
Yeah, absolutely. I would agree with all of that. I mean, it's basically any spare cash that's not required immediately. So you'd send money across to your investment account to work for you, because it's not working for you sitting in a business account getting close to zero. So you'd move it back in time for when you do need it. So this would be money that's earmarked for, say, your quarterly VAT bills or your corporation tax or anything like that. The alternative, of course, is if the strategy of your business changed somewhat. Obviously, different businesses have different aims and objectives and different opportunities that crop up from time to time. And the business may decide that it wants to set up a savings and investment part of its day-to-day activity. So it may say, we're generating a lot of money. So rather than having it sitting in our bank account, not working for us, in fact, as the guys have already mentioned, inflation will eat away at it, and it's got purchasing power in the future nowhere near what it had at the time. So you may want to protect that money and contribute on a periodic basis or a monthly basis, so that you can strive towards something particular in the longer term.
I think that leads pretty neatly on to my next question, which I guess I'll kick straight back to you in, and then maybe Jamie, you can chip in as well. What kinds of funds should these pots be invested in? We mentioned that beating inflation is the aim, but what determines which funds we should be investing in? Is it the time horizon that determines that? What should we be thinking about if we're a business?
Well, it really depends on your attitude to risks and the attitude towards the objectives and the strategy for any activity. So for most of us, it's important to remember that we're using money that isn't really ours. It's HMRC's money, or it is going elsewhere. So in which case, I would only consider really low risk money market funds. So rather than keep it in a close to business current account, I would put it somewhere where it could get 5% plus or work for you on that basis. And also you may decide as a business that if you did want to get into the field of, let's set up an investment account or a savings account, rather than using a bank's savings account, which traditionally has a pretty low rate, especially for business, even worse for personal customers, but a much higher rate could be gained by doing what we do, for example, as a business, which is look at very low cost, very broad market, low exposure funds that are either in global US market or in the UK markets.
Yeah, and that 5%, just to add on there, that 5% you mentioned there is the rate for money market funds. That's
currently money market, yeah.
That is the money market rate. So Sonia, I think it's 4.95%. And as a quick InvestEngine plug, we do have 2 money market funds on the platform, both of which are yielding about 4.95%. So it is very possible for business to earn that return on their cash rather than just have it sitting in a money market fund. Jamie, sorry, did you have something to add there?
Yeah, really to echo a lot of what Ian said, and I've been mentioned by Ellis as well, actually, previous to that, which is, your time horizon is incredibly important, because a lot of that, as well as how comfortable you feel taking risk, the time horizon pretty much dictates what level of risk is likely to be suitable. So if it's something that's, say, you're going to need the money back in the next couple of years, potentially, maybe even up to 5 years, then something which takes a lower level of risk, potentially something like a money market type fund, can work great, because it's hopefully keeping pace or close to with inflation. So it's still getting some sort of return. But that it's not likely to have fallen much in value, if at all, by the time you need it. But what I would say is that if you've then got, for whatever reason, your business, if you've then got a set of circumstances where there is cash there that you're not going to need in the next couple of years, or you've got that taken care of elsewhere, then absolutely the next place to look potentially is, okay, well, if we feel comfortable doing so, should we invest it into things like funds or ETFs? And that requires a bit more research or hand holding from somewhere to help you do that potentially. But the potential returns from that, can be pretty significant. So, global stocks and shares, for instance, which you can get with an ETF or a fund, typically over the long-term average, typically returns about 12% a year on average, which is a pretty punchy number. But that doesn't mean to say that that's a free ride. That comes with a pretty lumpy up and down ride, and not everybody's necessarily got the stomach for that, for investing their money that way. But if you do, and if you're comfortable taking that level of risk with money that you don't necessarily need in the next few years in the business, and it's for whatever other purpose, that is an option to consider.
Just to jump in and to add to what Jamie just said, we can see that around 70% of our customers are actually investing in the index funds and not the money market funds. We're focused a lot on the lower risk end of this investment proposition. But 70% of our customers that typically have long-term financial goals, they can take a little bit more risk, and they either build their own portfolios of index tracking ETFs, S&P 500, global trackers, FTSE, or they let us manage their funds for them, and we have the managed portfolios for a small fee. If you're unsure about what portfolio to build, we can match your risk profile to one of our model portfolios, and that's a popular product as well for those who are just beginning their journey.
Yeah, but who have that longer term time horizon, right?
That's right.
Yeah. So moving on, I think in general terms, investing business cash just seems to be still quite underutilized by businesses. And I'm kind of curious to hear really why we don't see more businesses making the most of those pots of cash that we mentioned earlier, those VAT returns, that kind of thing. So my question really is, what are some of these challenges when investing business cash? And really, what guidance would you have for other businesses who might be considering it? So I know Andrey and Ian, you've both been investing business cash for a long time. So maybe this is one for you guys to take.
Yeah. So I think the main reason for lower adoption is general awareness and education. Very often, business owners they're not aware business investment accounts exist, and this is why we are organizing webinars like this. From the point of view of a business owners, there are, as we mentioned here, there are several challenges and things to be aware of. Liquidity risk is one of those. You need to make sure that you have enough cash in your business, and because our investment account is easy access, so you typically can get access to your funds within 4 or 5 business days. But you need to be aware of that. Obviously, market volatility still exists. There is a risk that your investments can go up and down. And also tax regulatory implications. You need to talk to your accountant and financial planners.
Yeah, I see. There's a lot of similarities there with some of the thoughts I had on that, because when we looked at it, it was something we were looking for. So you get a lot of firms that don't realize that this facility is available, but it's necessary, I think, to understand, the what and the why you're doing it. So depending on the nature of the business, you can have a different decision-making process. And I know that there's just a lot of comfort with business owners of seeing the money sat there in their business account and seeing it in their bank account. Banks really do offer that kind of security, but in terms of sort of a latent security, because it's just as safe elsewhere, but you can make it work for you in a much better capacity. So I think it's just getting over that, and it's one of those things that if you're not actively striving for something like this, it's always going to be on the back burner. It's always going to be one of those things. You don't wake up one day and say, hey, do you know what, this is what I want to do. This is it's not it's kind of sold, not bought. So you've either got to go and do the research yourself, or you need someone to come into your life and say, hey, you got all this money sitting there in your bank account. There are other things you can do with it.
Yeah, well, hopefully this webinar is food for thought for the people that are watching.
Yeah.
My next question is one that I know that a lot of people in the audience are going to be interested in. We've done one previous webinar on business accounts, and this was by far the most popular question. And it's all about tax. We do get asked about this a lot. Ellis, we're very fortunate to have a chartered accountant on the call here. So this is probably one for you to answer. How does investing in a business account affect a business's tax liabilities, and also how are the underlying investments taxed as well?
Yeah, obviously a business can invest in a lot of things, from pension, obviously that then reduces taxable profits, reduces the corporation tax for a business. Now, once an investment goes into, say, a fund, it obviously then goes into the balance sheet because it's an asset for the company. Typically, there isn't any sort of corporation tax relief for that investment. If there is gains, there is obviously corporation tax on those gains, if that makes sense. So I think from that point of view, it's relatively simple, but also if the investment goes down in value, there is a degree of relief for that.
Yeah. And I think
a lot of it is like bigger picture thinking. Going back to the actual previous question, is bigger picture thinking rather than just sitting and hoping for the best of the cash. It's what can I actually do with that money to actually further my business, which essentially relates back to what your goals are for the business and how could I actually use that money to get to my goals faster.
And how does it work with keeping cash inside the business versus taking the cash outside the business and then investing in a kind of personal capacity? I know a lot of directors choose to kind of take their income from companies as dividends because it's usually more tax efficient, because I think you don't have to pay national insurance on dividends, but correct me if I'm wrong there. And the dividend rates are lower than income tax rates. So it's quite a tax efficient way for directors to do it, right?
Correct.
And I guess, I mean, tell me if I'm wrong here, but the general idea of investing via your company is that rather than paying out profits in the form of dividends and being subject to dividend tax, you can keep the cash inside the business and then invest any business profits before paying that dividend tax. Is that right?
That's completely correct. So dividend tax at basic rate level is currently taxed at 8.75%. As a high rate taxpayer, 33%, sorry. So if you take the money out of the company and it's declared as a dividend, say argument's sake it is £100, just make it a nice round figure, you've got to pay dividend tax. Therefore, you've got less money to invest. Therefore, you need a high return on investment before it actually makes sense to do that. So that's the benefit of actually investing via your limited company, is there's no tax taken off immediately because there's no personal tax to pay, if that makes sense.
Yeah. You still have to pay the tax at some point, right?
Correct.
But I guess the idea is, like with all these tax schemes, most people have a lower income later in their life. So the eventual dividends will probably be taxed at a lower rate than if you withdrew the tax, the cash today, sorry. So tax isn't totally avoided, it's just kind of delayed until the future. Is that right?
That is correct. And I think the best way, if you do it through your limited company, is you've avoided the personal tax liability because there's no personal dividend tax. And you're only making a taxable event if there's a gain on that investment. If there's no gain, there's no tax.
And so let's say we're getting interest income from our bond ETFs and things like that. Are they liable for corporation tax as well?
Yes, correct. That's ultimately the downside. The gains that you'll make is it go on your income, the company's made interest, etc. Therefore, you'd have to pay tax on that.
Basically, any income you'd make would be taxed in the same way as anything else the business would do.
Correct.
And we've got a few clients as well, I think, who are in the lovely and very fortunate position of having already maxed out their personal pension allowance, which I think is 60,000 a year, right? So I guess another benefit is that if you're in that position, if you've already maxed out your 60k into your pension, any contributions above that 60k, if you're making your personal capacity, are subject to, I think, income tax rates. So I guess if you have a business as well as investing in your personal capacity, you can then invest anything above that personal allowance, your annual allowance, into your business, and that's a nice strategy there. Is that right?
Yeah, completely correct. This allows you to invest more money than the allowances, and actually put money to use and actually get a better return, or more of a return, because you've got more investments.
Obviously a very nice problem to have if you've hit your pension allowance.
Correct.
Yeah.
If you've hit your pension allowance, you could always put it into someone else's pension.
Right, we're getting kind of to the end of our main Q&A section. We're motoring through these questions. My final one is an InvestEngine kind of specific one. I guess it's one maybe for Ian to answer, because I know you're an actual client of InvestEngine, and then maybe Andrey to chip in as our CEO. But why should businesses be investing with InvestEngine specifically? What is it about InvestEngine that works well for businesses looking to invest their cash?
Yeah, I'll go first to this one, because being a perfect example, as I said earlier on, we were looking for something specific, and I couldn't find anything where we could invest our spare business cash. Our bankers couldn't help. There were some others. I did a bit of research, and I think InvestEngine came out as one of the early ones that we saw. I thought, well, this ticks all the boxes. And one of the key things here, I mean, we're not telling people to become fund managers or anything like that, but one of the key things is the simplicity. The simplicity of using that platform is clean, it's clear, it's easy, easy to transfer money over. The whole process is easy. And you also get great visibility within the app. There's a huge range of options if you wanted to do anything other than money market funds. And the auto invest facility is great. And I like to get a little bit nerdy, so I like to drill down into some of the areas and the numbers. So with our broad market accounts, you can drill down and see all the sectors that's involved in, and the percentages and things like that. And you can do a lot of your own analysis. But essentially, if you just wanted to get your money working harder for you, working better for you, it's just a very simple and effective tool to use, in my view.
Yeah, thanks for that feedback. That's really important. Yeah, so when we launched business investing accounts 5 years ago, we looked at what was available, and there was not much. You had your bank paying low interest on cash. There were a few P2P lending options, which is not, in our opinion, is not a great option for business owners. And what we offer is a very balanced proposition. We have over 700 exchange traded funds. They're all curated by Andrew and his team. No super high risk leveraged ETFs where you can lose all of your money. It's index tracking instruments that are generally good for the long-term investor. So this is one of the advantages of our platform, but also one of our key values is keeping your costs low. So by keeping your costs low, the costs compound over time, especially if you're investing for the long run, and they eat into your profits, into your interest. So we are one of the lower cost options available. And also something I also already mentioned is our managed portfolios. So we can manage your funds for you. If you are a beginner, if you are unsure what to invest in, then for a very small fee, we can match you to one of the portfolios we have based on the risks you are ready to take. I think these are the main high level benefits. I don't want to sell it too much.
Right.
Sorry, yeah, I was just going to add on there, Andrey, to what you were saying there in terms of you're absolutely spot on with how important those costs are and keeping those low, and the access to market tracking investments. Certainly, as a independent financial planner, of course, I've got access to kind of all of the different available investment options for my clients from all different sources. And in the way that I advise that clients generally invest their money is very, very similar to what you set up through InvestEngine, which is low cost, market tracking, evidence based, and not the kind of super high risk leverage stuff like you mentioned that you don't do, but the stuff that will track kind of recognize stock markets and things that make it accessible for people to make their money work harder at a low cost, because that's so important.
Yeah, absolutely.
Well, then we've done really well with getting through those questions, so hopefully people have found that useful. We've now got a few minutes, about 10-15 minutes, which is good because I've seen we've got quite a lot of engagement in the Q&A. If you do have any other questions, just stick them in the Q&A box. They're coming straight to us. So we've got a few minutes now to go through some of the questions from the audience. So let me just open up the Q&A box and see what we've got. Okay, let's start with a kind of general one then. Looks like we've got a question here about the types of businesses. What types of businesses can open an account? Can self-employed people invest as a business? So I'm not sure who's best. Maybe that's what Jamie or Ellis, maybe best place to answer that one.
So in terms of self-employed people opening business accounts,
people invest as a business, and yeah, what types of business is it? Can any business invest in a business capacity?
In theory, I mean, if you're a limited company, the rules. This is probably slightly more for Ellis than myself, but as I understand it, if you're a limited company, then the way that you're taxed and the way that you can invest is somewhat different if you do it in a purely kind of self-employed sole trader capacity. Because if you're a sole trader, in essence, your personal and your business income kind of blends from a tax perspective, whereas as a limited company, it is a separate structure to you as an individual. So yes, there's no reason you can't do it if you're self-employed as a sole trader rather than a limited company, but it probably just work out slightly differently for tax purposes.
I can talk about our platform. So we work with limited companies, and any limited company can open an account with us. Looking at our client base, a lot of those limited companies are one-man bands, freelancers, contractors. We have some bigger businesses with hundreds of employees, but a typical client is relatively small. Sole traders on board as individuals, and we support both types.
Yeah, from a tax perspective, your sole trader, self-employed person would be taxed as an individual. There's no separation in terms of legal entity. You are the business is you. So when someone says that investing as a sole trader, you're investing as an individual in comparison to a limited company, which is a separate legal entity. And therefore different tax rates, etc.
Speaking of tax rates, we've got hopefully a very quick fire answer for you, Ellis. Is the tax event triggered at the moment you sell out of a fund only? Are you taxed on unrealized gains, or is it realized only?
Off the top of my head, as a limited company, I think, correct me if I'm wrong, I think Ian had backed me up on this if I'm incorrect. On the assumption of the year end is, say that no, the end of October, we would need a valuation on the investment as of the year end. If it's increased in valuation, there would be a taxable event. Is that correct, Ian?
Yeah, I'm not an expert on here, but as far as I'm concerned, if any dividends are paid, then those create taxable events, as in the same way it would do for an individual. So if you don't realize any gains, but there's activity within the, especially accumulating one, there are tax to pay on those dividends that you've acquired. If it's a distributing one, then that's easier to see because you can see exactly the amount of money that you've made because it gets put into a cash account next to your investment. So that's the gain that's been realized. As far as the company is concerned, I think the same taxable events dictate.
Yeah, we show on our platform, we show if a fund is distributing dividends or accumulating. So you will, if you want to choose a type that's accumulating and never paying dividends, it's very clearly displayed. So in that sense, it's really good.
But I think an important point with the accumulation funds is that point that Ian mentioned, that you do have to pay tax on I think they're called deemed distributions or something like that, excess reportable income. You do need to pay tax on that. So it's slightly more, I think it's slightly more onerous and a bit more complicated if you have an accumulation share class, if you're investing in a taxable account, to figure out what the excess reportable income is, because you do still have to pay any tax on kind of what you would have received were that a distribution share class. We got a couple of kind of InvestEngine specific questions here. Which is probably for you, Andrey. What are the charges for business accounts? I guess that's kind of an important one. And obviously reporting, as we've mentioned, with kind of tax liabilities and stuff, that's an important one. Do InvestEngine provide statements or reports to show money going in and out and any interest, dividends earned, as we need to complete these for the accounts?
Yes, we do provide all the reports. You simply in the interface, you tell us where your tax year begins and ends, and then you can press a button and then we'll generate all the reports for you. You then give the reports to your accountants and then they figure out the rest. In terms of the costs and charges, the fee structure is very simple. If you want to DIY, to build your own portfolios, then there is zero fee, zero commission. You do it for free. If you want to let us manage your portfolios for you, we charge 25 basis points annually management fee on the value of your assets. Funds have their own underlying costs. So you need to be aware, and we clearly display fund fees. We have nothing to do with those. Those are charged by the global fund providers, and I think this is it. No other fees. Was there anything else in that question?
No fees for the business accounts. Maybe it's worth touching on LEIs. That's not included in the question, but obviously LEIs are an important bit for businesses as well.
Yes, so LEI is a legal entity identifier. So it's a number that you need to have, basically register your company and provide this number to your investment platform. So there's a small cost, around £50 a year. And for our new customers, we cover that fee for you just to make it easier for you. That's all on the LEI.
Ellis, I got a question specifically for you because you've been called out in this question. So it's coming straight to you. As a limited company, is there a limit to what the business can invest in its portfolio? This person took advice and was told that HMRC doesn't like to see trading companies almost act like investment companies. Is there any truth to that?
Yeah, the typical conversation with clients that do want to invest is, I think there's a 20% limit of the total value of the assets of the company. If they're going in excess of that, they'd be technically classed as an investment company. Below that, it becomes more acceptable.
And what are the penalties for going over that limit?
I believe they'd want to change the status of the company to an investment company. I think that's what they consider, and therefore the whole realm of the business changes.
Okay, let's see, what else have we got here? Oh wow, we haven't got a question, but I'm going to read this out because it's a good InvestEngine testimonial. Not a question, but a key reason to use InvestEngine is their business model. InvestEngine does not make money with your money unless you ask them to manage your portfolio, which means there's no perverse incentive that can backfire. There we go. So, thank you very much to whoever wrote that one. Entrepreneurs Relief. Ellis, I realise that I'm firing questions at you here. Jamie, maybe this is one for you as well. I don't know whether either of you, Ian as well, anybody here is familiar with Entrepreneurs Relief, but there's someone here who's worried. There we go. Thanks, Ian. Somebody worried about losing Entrepreneurs Relief if they invest the cash outside the business. Is that correct?
I was saying goodbye to a colleague. Sorry, I wasn't putting my hand up. Yeah, I'm probably one of the least to answer that on the specifics. Sorry to put you on the spot, Ellis, but this is probably a good one for you.
Can you repeat that question? I didn't quite hear.
Yeah, it was about Entrepreneurs Relief. This person asking the question is worried about losing Entrepreneurs Relief if they invest the cash outside of the business.
So if they invest the cash outside of the business, when they say that, do they mean? Okay, I'm just trying to understand the situation. But
I'm trying to understand it. So I guess it means if they take the cash out of the business and then invest it in a personal capacity, like in a SIP or an ISA or something like that.
So Entrepreneurs Relief is typically when you sell the business. So if they're taking the money outside of the business, that has no effect on the Entrepreneurs Relief. Entrepreneurs Relief is when you sell the business and you get, at the moment, 10% tax on the first £1 million of the business sale. As of today, there's a government budget on the end of October, which can obliterate the Entrepreneurs Relief.
I'll jump on the back of what Ellis was saying next. It looks like he might have frozen. If it's not
business asset disposal relief, whichever you want to call it. I think my signal's gone.
Oh, you're back. Sorry, Jamie, do you want to take over?
Yeah, no, I was just going to say, but if it is the other interpretation of the question, it actually ties in quite neatly to what the last question Ellis was providing an answer to, I think, which was around that limit, whether you're deemed a trading company or whether you're deemed an investment company. So I think it's, if you go over that 20% threshold and you get treated as an investment company, then my understanding is you then lose access to business asset disposal relief. So as long as at the point you were looking to sell the business and utilize that business asset disposal relief, or used to be called entrepreneurs relief, then you'd need to make sure that over 20% of the value of the business wasn't held in investments that would then lose that status.
Oh, that makes sense. Got it. Yeah, that's useful.
That is correct. Sorry, my signal actually went, but yeah. The opposite side of the thing, if they've not taken the money out of the company, they want to invest into the funds via the limited company, as long as they've got that 20% limit. If it's under that, they'd still be entitled to the reliefs on selling the business.
Got it. Thank you very much. We've got a couple of questions here on money market funds. I know this can be a bit of point of confusion because it's not something a lot of people know about or invest in. And I guess this is one that I'm probably best placed to answer. We've got one question here about is the money market account for a fixed term? The answer to that is no. They are funds. They don't have a fixed maturity date. They track what's called the SONIA rate, which is an overnight rate, which tends to track pretty closely to the underlying Bank of England base rate. Currently, SONIA is 4.95%. As I mentioned earlier, we've got two funds on the platform, CSH2 and XSTR, both really good. They're technically not money market funds, they're overnight funds that track this overnight rate. And yes, you don't need to invest for a fixed term. You can invest as long as you want. You can leave your cash in there as long as you want. And it will just compound at that 5% annually in the same way that it would do if you just put it in a really high yielding current account. And another question here on just trying to understand the question. For money market funds, do I need more time to monitor the ups and downs of it? And the idea of the money market fund is that it doesn't go up and down very much. It's very safe. It's very stable. The actual fund itself invests in very low risk securities. They do have a very small risk attached to them. So it's an investment rather than a cash holding. So investments can go up as well as down, or down as well as up. And so it is worth bearing that in mind. But having looked at the performance of these money market funds, I mean, the maximum drawdown on the XSTR ETF, which is the X-Trackers one, I was doing a separate presentation on this the other day. And the largest drawdown it had over its existence was about 0.16% or something. So for all intents and purposes, it can be treated pretty much as cash. I mean, it's not cash, it is an investment, but in terms of return profile, it's much more similar to cash than it is to an investment.
And the funds compound daily, right, Andy?
Exactly, yes.
On that point, one of the previous questions I answered was about, why some businesses still don't do anything with their spare cash. Another thing I forgot to mention is some people take the view, well, interest rates are coming down now, so what's the point? By the time I get my account sorted out, put the money in, then I may not be getting much of a benefit. Well, the first thing is something is better than nothing, because you can bet your bottom dollar or euro or sterling, whatever, that once the banks reduce their interest rates, which we expect that to come down, that will be the last one to affect the money market accounts. And there's an article in the New York Times a few days ago about the changing interest rates now that we've seen the Fed move their interest rates down. But it's not going to really affect the money market accounts too drastically until that drops, or inflation, or the interest rate drops below 3%, which they don't think will happen until about 2026. So basically, if you think there's no life in the money market accounts or it's declining, there will be, from what I understand and what I'm reading.
Yeah, I think that's a kind of underutilized, just touching on that similar point, it's a kind of underutilized benefit, I think, of the money market funds, is that there's no admin. Like with current accounts, it's a bloody nightmare. You've got to constantly figure out which account has the best rate, if you've got any introductory offers, bonus offers, that kind of thing. And all the banks are obviously taking different cuts. And at any given point in time, it's always a different current account that's paying the best rate. Whereas with money market funds, you can just kind of stick your cash in there and you can be confident, because you know it's tracking this overnight rate, that it's always going to be giving a very competitive, usually the best rate and better than any current account. So not only is it best in terms of like a pure financial return perspective, but it's also that kind of peace of mind that you know that you're not going to be getting a much better deal if you go somewhere else, and that kind of nagging feeling that you should probably do something with that spare cash.
Yeah.
Right then, let's have a look, see what else we've got on here. Okay, Andrey, probably one for you. Just about protections. I know a lot of people are wary of investing business cash, especially if it's used for tax returns and things like that. And what sort of protections do businesses have if they invest their cash with InvestEngine?
Yeah, FSCS protection still applies in most cases, so 85,000. And then your funds are ring-fenced from the company funds, so it's segregated bank accounts. All your invested assets are still yours. It's your funds. In the unlikely event the platform goes bust, you can transfer your funds to another provider. So it's pretty safe, I'd say. Okay,
now we're just about to hit, there we go, just hit 5:45. And so given that it was my job to keep us on time, I think that is about all we've got time for. Now, we have taken note of all the questions that have been asked in that Q&A box. So if we haven't answered your question today, then we will try and get back to you over the next few days. Alternatively, you can always email support. Their email address is support@investengine.com. We've also got a forum, a community forum that you can post on, and we'll answer any questions that way. So I suppose all that leaves me to say is a very big thank you to all of our panelists for your time today. I think it was a really useful session. I hope everybody watching found it helpful. I know that given the number of questions that people were obviously engaged in, I'm glad that people did find it useful. If you want to find out more about business accounts or you want to open one yourself, all you have to do is go to investengine.com/business. It's a very simple URL, and you'll find all the details there. Okay, thank you for joining, and see you next time.
Thank you.
Thank you.